Hello everyone and welcome to your Glassnode video report for week 25, 2023. So, it's been a bit of nothing, right? The market is really sitting pretty stagnant at the moment. We've had a little bit of upside over the last 24 hours. Bitcoin dominance is starting to rise. This is kind of aligned with what we've been talking about, where capital is still flowing up up the risk curve. But really, we've kind of got a market where there's just very, very little volatility, there's little volume, and there's little realized value. There's just not much going on. And what we want to do this week is try to just give a bit of perspective on where we currently stand across many of those kind of volatility and activity type metrics, but then also putting it into context and saying, okay, well, what does that mean and how does this look compared to prior cycles? So that's really going to be the frame of reference we're going to look at it for today. Now, the reason we've called it a volatile road to nowhere is because this is actually very similar. This is what we call the peak apathy phase. And it really is the hangover from a bear market. Once we've had these enormous drawdowns, and we've seen this in every prior cycle, if you go back and look at the 2019 to 2020 period, for example, or the 2015 to 2016 period, both of these you can argue were all in a bull market because the bottom had been set. But at the same time, that was 2 years or 2 and a bit years of kind of sideways in the 2019 case, up to 14K, down to 3,800. And it was like a long-term macro consolidation. So on the wider scale, it was volatile, it was chaotic, and it didn't actually go anywhere. But in many ways, the bottom was still already in. So you could argue that that period of time was a bullish market. You could also make a case that 2019 was a bear market. We had the rally to 2014, and there was another 12-month bear market period that followed. So really, it all comes down to almost the definitions of these things. But at the end of the day, who cares whether we want to call it a bull or a bear market? What we really care about is what is going on under the surface. What is the things that actually matter? And given that we have such a low volatility environment with such low volumes, we actually have to start looking a little bit deeper and trying to understand what's going on in the supply domain and how does this compare to prior cycles so we can understand the mechanics of what this may mean. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people, and let's get stuck right into the action. Okay, so what we're going to start with is looking at several volatility metrics, things that kind of show us that the market is just dead asleep. There is just not much going on across many levels, but also this is not uncommon for periods of time that look like this in prior cycles. So the first one we're going to look at is the 30-day price high and low. So basically, what is the highest price that Bitcoin has traded in the last 30 days and what is the lowest price? And the gray bar down the bottom here is showing us the spread between those two. So obviously during bull markets, things are crazy, right? The market's rallying, we've got big corrections and big explosions to the upside. So these tend to widen out. And what you end up with is an expansion. This is kind of indicative of upside volatility. Now you'll see that the volatility on this metric decays into the bear market. Here's a good example in November 2018. After we had the capitulation, which is obviously a widening of these bands, it goes dead quiet for a period of time. We had the exact same after the FTX event. It just goes dead quiet. There's just not much happening. This is kind of the apathy, the post-hangover. Bull markets tend to see widening spreads between the upper and the lower. Bearish markets are a slow decay. And then once we've actually put some kind of a floor in, right? 2015 to 16, very, very quiet. If we go here in 2023, very, very quiet. Most market participants have been flushed out. It's only really those with the highest conviction that are around. And generally speaking, these things take between 6 and 18 months to actually fully play out, to kind of digest the chaos that was the bear market. Even if it is a gradual drift higher, it takes a long time for that to filter through the market. And by the way, we see this in many assets. Bitcoin is not unique in this instance. It's just we happen to be able to see it really well with on-chain and off-chain data. Now, obviously, you can see this with any asset, but we're just looking at Bitcoin here. So we can see the very same thing with realized volatility. And what I've highlighted here in blue, same concept, it kind of peaks around the same areas. But what I've highlighted in blue is where on our current level of realized volatility on a 30-day basis, where are the periods that we've seen lower than? So think about it in the other direction. We're looking for areas where we have similar levels of low volatility. And what you'll see is it's not exclusively following a bear market. Here's November 2018. It was very quiet before the 50% sell-off. Same here in the middle of the 2014 market. So it can go in both directions. But on net, when do we typically see this type of behavior? The 2015 to 16, the hangover from the bear, the long sideways grind back towards the all-time high, but this took many, many years to achieve it. We saw it in the doldrums after the sell-off here in early 2019, before we kind of rocketed up to 14,000. We saw it here after the COVID sell-off, where the market's kind of digesting, where is the world going to go at this point in time? We saw it right before FTX and for many periods through 2023, where it's just very, very quiet, digesting that move. And we saw it in 2012 as well, right? This is kind of this, again, sideways grind with a gradual upwards drift. This is typically seen, these low volatility extended environments is typical of the post-bear market hangover. If we look at options markets, now options have only been around for a shorter period of time relative to obviously the asset itself. We are down at the second lowest level. The only time it's ever been low is after FTX, but the second lowest level of options implied volatility. So even the market, the derivative markets, are not pricing in a great deal of excitement ahead. So very, very quiet, very calm and collected. There's just not much going on. It's starting to look like that period of apathy. Now we can go even further. I mean, there's every metric under the sun that's explaining a similar story. This is futures volume for both Bitcoin and Ethereum. On the red here, I've got marked up is their combined, so total futures trade volume. Again, the only time it's been lower was following the FTX collapse, right? This is kind of the Christmas lull where there was like almost nothing happening. I mean, if you go back and look at our reports at the end of the year, at the start of this year, I think Bitcoin traded within literally a $59 range for like 2 weeks. So just more dead than you can possibly imagine. We are really not that far above it. We are below pretty much everything through the 2021 to 2022 cycle. We're basically back down to pre-$20,000 all-time high levels. So super quiet on the trade volume front. This has obviously got market makers and the like pulling back. There's a lot of pieces to this puzzle. And the last one on this view is the realized profit and loss. This is looking at all the coins that are moving on chain and actually assessing how much profit or loss are they locking in. And in the orange, we've got their combined level. And as you can see, I mean, we're pretty much back down to here, October 2020 levels. Bitcoin was between $11,000 and $10,000 back then. So, I mean, we are talking about really, really quiet stuff, whether pricing models, volatility models, off-chain trade volume, or on-chain transaction volume. It's just quiet across the board. So given that there's just nothing happening and it's all dead, well, where do we start to find signal? And at the end of the day, as we've seen, these things typically happen in that post-bear market hangover. So let's just assume that that's the case. Obviously, we don't know. We can never predict what the future really holds. Let's just take that as our working model, because at the very least, on a probability standpoint, that is what we typically see around these kind of apathetic periods. So what we're going to focus in on here, because after the bear market, you shake out many of the speculators. Most of the tourists who just come for the number go up. They generally don't make it through the bear market. But who really doesn't make it through is the time pain. The time and the duration, the 2019 sideways, long, boring, volatile grind, where eventually the market convinces everybody that the asset will never come back. And it's just boring and sideways and nothing happens. And that time pain is a very real thing. I mean, ask your local gold bug what it feels like to sit through a decade-long sideways transition to get back to all-time high. Very, very few people make it through that journey, where, with Bitcoin, we just happen to see this on a shorter time frame compared to gold. Somewhere on the order of about 2.5 years is kind of what this looks like. So the first metric I want to look at, we're looking for the HODLers, the people who remain. We kind of care about the strong hands here. And what we're generally looking for is what are their patterns of behavior during this apathetic phase. So the first one to look at here is liveliness. Now, this is a really, really powerful metric, and you'll be hearing a lot more about this in the near term, which I'm very excited for. So stay tuned for that. Liveliness is a great metric that basically looks at a big picture. How much holding time, we call it coin days, right? How many coin days are being accumulated by the supply versus destroyed on a macro scale? Uptrends, as you'll see this during the 2021 bull market, and steep uptrends particularly means lots of holding time, lots of old coins coming back to life. Basically, this is like spending the holding time. So uptrends mean there's a lot of spent holding time. HODLers are exiting their position when liveliness is trending higher. Now, what you'll see is that that's typically, I mean, we're here at the end of 2020. That goes through to May 2021. So let's just, for argument's sake, say this is about 6 months. The bull market, the real impulse in the bull market is about 6 months long. So what on earth is Bitcoin doing for the other 3.5 years during the 4-year cycle? Because we keep seeing this 4-year cycle play on. Well, during that 4-year cycle, liveliness is in a big long-term downtrend. It has these spikes here and there, but on aggregate, it's trending lower. So what's that actually mean? It means that people are not spending old coins, which actually means they're taking coins off the market and accumulating coin days. It's an indication of hodling. Now, the big difference is that it only takes a 6-month rally for them to distribute and sell and basically kill the bull. But when it comes to the bear, it's a 3.5-year long, sideways, painful, grinding downtrend in liveliness. It's the slow and steady accumulation. It's what the buyers of last resort, being the HODLer cohort, are essentially doing. They'll put the floor into this market, but it takes a long time and it's volatile and painful. This is the sideways chop. So as you can see, we essentially started this process around this time in 2021. So we've kind of been at this for almost 2 years now, right? This whole process of this long sideways acceleration of HODLers accumulating coins. And as you can see, we can have a lot of volatility between here and there. So whilst that may be kind of daunting that there's, 3.5 years, well, that sounds pretty dire. Really, that process started about 2 years ago. So in theory, that puts something on the order of, let's say 6 to 18 months ahead of us, right? That's kind of the ballpark that we're talking about, if past cycles are any guide. And we'll see more metrics that describe this as well. So here we are looking at, we can take liveliness. So we know that HODLers are hodling. That's kind of the base case that we've got here. We can bring that into the supply domain using the HODLer net position change. So what we're looking at here is if we're seeing this accumulation and these coins coming off the market, we can establish the rate at which that's happening. And at the moment, it's about 49,000 or 40,000 BTC per month. So these are coins that are basically going from the market into cold storage. So this is real HODLer behavior. Now, what you'll also see here in the green is that slow and steady accumulation. Note how it starts back here in 2014, pretty much just after the cycle has peaked. We go into the initial contraction, and then it's just this long, slow, grinding, painful, to be honest, process until we get back to the all-time high. As the market gets to the all-time high, they start to spend at scale, and you see the massive HODLer exit position. Then we get that first contraction, the first sell-off. They realize, okay, I think the bear market's back in play. It's come down from 20,000 down to 10 or 6, I actually think it sold off to. And they move back into the long, sideways, painful grind of slowly taking coins off the market until we get back to the previous all-time high, and the cycle repeats. So here you go. You can see again in around May, June 2021, we move back into this slow, steady, boring, sideways grind. Also note that we have the capitulation events, right? These people who did hold their coins. There's a lot of people who get flushed out at these bottoms. A lot of people get flushed out on the FTX bottom back here in November 2021. We've even got March 2020 that shows up. But you can see that these patterns, they play out cycle after cycle. It really is demonstrating or kind of showing and observing the transition of coins from those who really understand what Bitcoin's about, right? Coins flow towards them and they flow away from speculators. They flow away from people who don't make it through either the bear market itself, which is kind of the downwards pain, and then there's the sideways boredom that generally follows the hangover period. And very, very few investors make it through that process. Again, not just for Bitcoin. This is kind of a market phenomena. We just happen to be able to visualize it really clearly when looking at Bitcoin and on-chain data. So we've kind of set the tone. There's this undercurrent of accumulation that's taking place. The hodlers are still there, but we know it takes a long time for them to clean up the mess. It takes a long time for those coins to finally reach the strong hands where they're not going anywhere, right? Until they get to the next all-time high, and then away things go. So with that as context, we've got two traces here. The orange curve is balance held on exchanges, which we know has been in a fairly substantial downtrend for many years now. It's kind of this long, massive downtrend, which continues actually toward a fall to the downside. We are still seeing coins getting pulled off exchanges. So again, it's adding more weight and confluence to this concept that accumulation is taking place. The blue line here is the illiquid supply curve. Now, what we define as illiquid supply are essentially coins held in a wallet that has very little to no history of spending. So if somebody spends their coins, well, then their history of spending goes to 1, but they also hold no balance anymore. So they're no longer illiquid. They will move to some other wallet. The converse of this, if you look at what's the opposite of illiquid, well, it's liquid and highly liquid. And a large portion of those are exchange balances because they've got hot wallets. They're constantly moving coins around. So the entity that represents exchanges, you can kind of think of these as being inverse to each other. Illiquid supply is typically capturing more of an investor type behavior, whereas the exchange balance is obviously coins that are on reserve. They're kind of trading, they're mobile, they're liquid. They're kind of part of the available supply. Illiquid supply is much closer to the unavailable supply, those that are in cold storage. So note that our illiquid supply is actually pushing to a new all-time high, 15.2 million BTC, at the same time that our exchange reserves are declining. So again, we've got HODLer supply increasing around 40 to 42,000 BTC a month, and we've got illiquid supply pushing to a new all-time high and exchange supply falling down to very low levels. Okay, we're starting to get a bit of a picture here that there is in fact accumulation going on under the surface, right? Again, it takes time. So we have to try and ground ourselves. These things take time. They're a process. But at the same time, we can kind of, if you look at this process and assuming that this continues to move along, we start saying, okay, what if it starts to look like prior cycles? Because so far, it has many similarities to what we've seen in the past. Now, to quantify these things, right, how big is the accumulation that's taking place and which entities are participating in it? So we talked about this in a report recently called the Shrimp Supply Sync, which if you haven't read it and you're interested in the Bitcoin supply, lots of people like to say, oh, Bitcoin's held by a couple of whales. Well, we can actually prove with data that that is not true. These two metrics are really, really cool. They're an offshoot from that report. We call these the absorption rates. So what we're doing here is trying to find a relative level. So what's kind of a baseline measuring stick that we can compare how much shrimp we're acquiring, crabs, whales, different groups, cohorts. Well, a really nice and common kind of a metric here is how many coins are being mined. So if we have 900 coins per day, let's work out how much the balance of shrimp is going up or down, crabs up or down, whales up or down, and just compare it to the mined supply. So a value of 100% is, let's just for argument's sake, say 900 coins a day. Right, so if we see one of these cohorts is absorbing 100%, that means that they're accumulating 900 coins per day. That's the metric. If it's 200%, it means that they're growing at 1800. And if it's negative 100%, it means that they're actually adding to the distribution pressure. So you've got the miners who are putting 900 coins into the market, and the whales, for example, may be also releasing 900 coins. So that's kind of the measuring stick we're using. So what I really want to highlight here, and actually I'm just going to show this on a slightly bigger view than 5 years, because 5 years used to capture the 2017 top. It no longer does. Let's zoom in on this one here. So what we're looking at here is 3 cohorts combined. Shrimp, less than 1 BTC, crabs, 1 to 10, and fish, 10 to 100, right? We use these larger buckets because really at the end of the day, we're just trying to look at the aggregate pattern. So think about this top chart here as everybody with less than 100 BTC, all those wallets. Now, the first thing to note is that we had a large uptick over here in 2017. This was kind of the last major time we had massive accumulation by these cohorts. Think about this. This is as we rallied to 20,000 at really the wrong time to be accumulating coins. So people are literally buying the top over here. Right? I'm sure that I was certainly here. I'm sure there's many people listening who were in this cohort. Now, it was kind of slow and steady and choppy for all of 2019. We had a little bit of buying, not quite the top though. This is still down here. I mean, these people are still in the money, the people who acquired here. They actually distributed into the bull. So you can see that they were adding sell pressure. This went into a negative territory. They were adding sell pressure at the top of this market. Now, following, here's Luna and Three Arrows Capital, right? June 2022, massive push higher. We are seeing on the combined level 640% or 700% here. So what does that mean? Of all the coins that miners were issuing into the market, an additional 6 times that amount was getting absorbed by these smaller cohorts. We saw an even larger wave, 1,000, let's just say 1,200, so 12 times the mine supply was getting sucked into these smaller holder wallets following the FTX event. So note here, this is buying the top, this is selling the top. So the shrimp and the crabs, they actually learnt their lesson from back here and they sold into the market push. And here they are actually buying following major capitulation events. And we are currently ticking up to about 260%. So of the mined coins, the shrimp, the crabs, and the fish are taking an extra 2.6 times that amount off the market. And this has been kind of a long style, this is almost 12 months of fairly substantial and historically large absorption by these cohorts. Now, the sharks are also accumulating. This is the 100 to 1,000, but much, much less, only 30% of the mine supply. So they're kind of a small player. Whales, on the other hand, are actually net distributors. They're adding an extra 80% to the miner sell side. So if you kind of look at that equation, you've got all the small holders are taking 260% of the mine supply. You've got miners who are selling 100% because they sell most of what they mine. The whales are adding an extra 70%. Well, where's the rest coming from? It's coming from the exchanges. So what we are seeing at a macro scale, let's put all these pieces of the puzzle together. The majority of the market is accumulating coins right now, and they're putting them into cold storage, which is causing our liveliness to trend lower and HODLer net position change to go green. So the majority of the market is actually slowly and gradually taking coins off the market. Where are those coins coming from? Really, 3 sources: miners, whales, and exchanges. They're kind of the 3 entities which you can consider to be distributing. Even though exchanges aren't necessarily distributing, there's obviously holders on those exchanges. But again, we're just trying to give a kind of broad picture. But overall, that's the kind of spread that we're seeing in terms of what the data is telling us in how coins are moving around the supply, how they're being reallocated through this slow grinding process of the bear. So the last thing I want to touch on is just the concept of duration. Why duration? Well, we have been in these cycles before. And just to help people understand that given the circumstances we've discussed above, how long can this go on for? Right? How long? What does the 2019 sideways grind look like? Just so we can get a bit of an anchor, right? We never know how this is all going to play out, but just what have we seen in the past? So this chart here, you may have seen these before. These are duration. So basically it's saying the blue curve are time in bull market. And we time this from based on when the cycle low was, which obviously we don't know whether the cycle low is in until obviously the bull market plays out. So we're going to estimate across all of them before. But you can see that the bulls, typically, if you measure from bottom to peak, are typically, I mean, this one here was 1,000 days. This one over here back in 2013 was 735 days. You can see that our 2021 bull market went for 700 days. We're talking about somewhere between about 700 and 1,000 days for a bull cycle. Now, the other thing we've got here in the black line, this is probably more important. This is the transitional period from when the bottom gets put in to breaking the all-time high, right? Going up to new all-time highs. And for this one here, we're talking about a transitional period about 750 days. This one here took us 460 days. And this one over here took us 730 days. So give that a bit of room. We're talking about around 2 years, 730 days, thereabouts. We're talking about 2 years. How far are we into ours? 220 days. So that would tell us that between, based on previous cycles, we may well have an additional 500 odd days, year and a half, thereabouts, before we get back to an all-time high. And of course, we don't know we're going back to an all-time high. I mean, I certainly assume we will at some point in time. That's my personal conviction. But at the same time, just grounding ourselves to understand that these processes can take time. And if we use history as a guide, previously, we've got another 500 odd days of kind of sideways grind. We can see this in terms of different pricing models that we typically trade between. So these durations, you can see above the realized price, but not breaking out above the half standard deviation band. We spend a lot of time down here, and you can see the duration we spend within each of these different pricing bands. We may well have some time of sideways, non-volatile, boring chop to get through before it actually starts to trend back towards the all-time high. Now, the last exciting thing, just to kind of tag in there, is that the halving is in fact coming. And whilst we can all debate and discuss whether the halving has a true impact on supply and what the real meaning of this whole thing is, what we typically see, and for those of you who like geometry, you'll see that typically the halving occurs about 2/3 of the way through each of these transitional periods. So our next halving is, I think, 309 days based on last estimate away. So look, we will see how this plays out. I mean, the last halving that took place was immediately following the COVID sell-off. So we essentially had a 50% down in price, recovered, and then we had a 50% down in issuance, which is tough and brutal for the miners. But if we put all of these things together, right, it's very, very quiet out there. Volatility is low. We're still seeing many of the positive supply patterns that we typically see. However, it could still take, and we said in our report this week, somewhere between 8 to 18 months may well be ahead of us, if history is any guide for how long this kind of transitional period can actually take place. So thanks as always for tuning in for that, folks. Hopefully you found that a useful session. As I mentioned, it's quiet. It's kind of what we've seen in the past. We are in peak apathy, and the reality is that many investors do not make it through this period of absolute and utter boredom. So it is a process. These things take time. If we use history as a guide, it could be between 8 to 18 months. But again, history doesn't have to be a guide. And of course, markets can trade up, down, left, right, and sideways in that period of time. But at the very least, we've got a bit of a grounding for what has happened in the past. Bitcoin still kind of follows these 4-year cycles. It's just what we naturally see. The halving is about 309 days away. We will see whether the 4-year cycle continues to play out. So far it has. But again, at some point in time, it may break. Until that point in time, we will keep tracking it. So look forward to seeing you in the next one. I'll see you then. Cheers.